Hi, my name's Bill Blain. I'm Chief Strategist with Shard Capital, normally based in London, but of course, like everyone else, still working from home. And now that we're on the beginning of July and summer seems to have finished already, it's time for an outlook on what the second half of the year is going to give us in terms of markets. It's been a really extraordinary first half. We've never seen anything like it. It was the fastest ever market collapse in the first quarter, followed by the fastest ever recovery. We are only slightly down on this year, and if you look back, we're actually up on where markets were in some cases last year. But we get very contradictory signals from the markets. While bonds are higher, which means lower yields, that tends to point towards economic doom and gloom. Yet, of course, we see stock markets much higher, suggesting that the world's going to be in a great place. And one of the big problems is that due to the distortions of QE infinity, it looks like stock markets are seriously overvalued. Lots of people, especially the market talking heads, are declaring that that disconnect between markets and the real outlook is going to generate considerable problems. And many people are predicting that there will be a major sell-off sometime this year. And they're basing that on what they still expect is a very poor economic outlook. However, I'm going to take a slightly contrarian view. I think if you take a look at what's actually occurring in the real economy, it's actually much more positive. Although governments are getting blamed for a terrible response in terms of preparedness and the way they've handled the pandemic, from an economic and market perspective, well, they've actually done pretty well. And I think that the furlough schemes, the support for certain businesses, and bailouts for others have actually created a mood of confidence. Even though it feels like winter has already started here on the 1st of July, it actually feels like some kind of economic spring has begun. We're beginning to see new shoots in terms of a record number of new companies being formed and people looking to launch new businesses, taking a cue from government that they're going to support growth. And that's very positive. The second thing is consumers. Everybody has saved money during the crisis. It's a result of not having to commute. It's a result of not being able to go shopping, not being able to go out eating, and of course, not being able to go to the pub. As a result, people find they have money, and that money is burning a hole in their pockets. They want to go out and spend. And it's not just shopping, it's also in housing. And that's why we're seeing a run of very strong, surprisingly strong economic numbers when it comes to people buying houses, when it comes to purchasing managers ordering stuff so they can provide and supply consumer chains, but also things like retail shopping. People like online, but they also want to go and try stuff on before they buy. So we are seeing something of a snapback in consumption, and that is really surprising many of the dire outlooks that we had for the economy. So basically, I think my perspective on the global economy is a much stronger snapback than we expected, but it still won't be anything like the V-shaped recovery that many people have been expecting. There are a number of sectors that are going to have to adapt and change over the medium term, which are going to cause problems. One of these is tourism. And remember that tourism is some 12% of the global economy. And you've also got aerospace. Although Boeing is now flying the Boeing 737 MAX again, it's very clear that airlines don't want the particular plane. And even the ones that still have them on order, many of them are in serious trouble. Just yesterday, we learnt that Norwegian has cancelled an order for 93 of them. Not that Norwegian had any routes left to use them on anyway. The outlook for aerospace is particularly poor, but if we do see a rapid snapback, not just in consumer consumption, but also in their desire to take holidays, well, you might even get a surprise with airlines. Back in June, we saw Ryanair stage a spectacular rally on the back of being able to start flights earlier than expected. And that's generally the story of the snapback economy. Things are happening faster than we thought they would. That's because markets always tend to overemphasize the downside and downplay the potential upside of any situation. Or as I like to say, things are never as bad as you fear, but they're never as good as you hope. But there are going to be some problems ahead. There is the potential for a market crash. That's always there. And the reason for that is that although we have faster recovery, markets look overpriced. And by that I mean markets prices, especially in stocks, seem to be anticipating a global boom, whereas in fact, at best, what we're going to get is a slow but steady recovery back to where we were before the pandemic. Market prices are being held higher as a result of QE infinity. That's where governments are going out and buying bonds and pumping money into the economy. It depresses yields and forces people to go out and look for higher returns elsewhere. And that's what's been driving up the stock market, or at least it's one of the factors driving up the stock market, because of course, anyone looking at the stock market and seeing how much governments are intervening through central bank QE infinity are thinking this can go only one way, which is why retail investors are having such a great time at the moment. We'll wonder how they'll do when things reverse, which of course they might not. But no global rally lasts forever. There are always going to be corrections at some point. However, my main fear is not really the market moves. If we do get a correction, we know that people are going to be ready to step in and buy the dips. My main concern is going to be the financial system, especially banks. Some of the recent US bank stress tests, which introduced a number of key new considerations in terms of additional capital requirements, means that although the banks are paying dividends, they are concerned. And when you get a Fed governor dissenting on the basis that they're going to face massive trouble later this year, you know that even central banks are concerned. And certainly that's also true in Europe, where I expect that we're going to see a vast increase in the number of non-performing loans. Let's not forget that here in the UK, on quarter days, these are the days when people are supposed to pay the rents on their commercial property, less than 20% of rents actually got paid. That means landlords are in serious risk of defaulting, and already we've seen a number of supermarket chains, the owners of malls, start to go down, and that's likely to continue. That means mounting non-performing loan losses on banks' balance sheets. There is a risk, at least I perceive one, that the whole financial system is going to take a bit of a knock. And the market knows that, because over the last few months, we've seen bank shares vastly underperform the recovery in the rest of the market. Bank shares are still down 30 to 40%, depending on where they are this year, whereas the rest of the market is at most down around 10%. There are serious concerns about where banking is going to take us. But overall, my outlook for the next 6 months is a more positive than expected recovery, a snapback in consumption. There will still be problems from broken supply chains, and some sectors, especially tourism and aviation, aerospace, are going to take time to adapt, but the recovery will be faster than many expected, but it won't be the V-shape that some investment banks have been hoping for. Not that the investment banks' minds, of course. It looks like it's been a period for record income in terms of fees from bond market sales. And that leads me on to another long-term problem. Major corporates around the globe and small SMEs have been out borrowing as much money as they possibly can to shore themselves up through what was expected to be a long-term economic recession. The result of that is companies massively over-levered. And that leads us on to the next issue, which is, so are sovereigns. Sovereigns have borrowed an enormous amount of money to pay for the support packages, the bailouts and the furloughing, which has kept the global economy much stronger than expected. Now it's going to be interesting in the next few years how that plays out. Interest rates are historically low and we don't know how that is going to impact their ability to repay. Now, I'm not saying for 1 second that most sovereigns who have borrowed in their own currency are going to run into problem. No, they'll just print more money. But where does that create inflation? Well, it's not apparent yet. Does it create problems in FX? Well, again, it's not apparent yet. But it all depends on how the new monetary theories about being able to raise and spend as much money as is required actually play out in practice. And that's going to be very interesting over the next few years. Are we likely to see debt crisis? And will it spread to the corporate sector, where heavily over-leveraged companies are going to struggle to repay? It's going to be a fascinating time, but for the next 6 months, I'm actually quietly confident.